Happy Friday, traders. Well, we have gone from a market that was pricing in a temporary disruption to the global economy from the war and what is happening to surging crude prices and obviously with inflation as well. Now to a market that is pricing in that this is a lot more serious than what they first thought. So if we have a look at first US bond yields, so US 2-year yields, which were trading pre-war below the Fed funds rate, which is at 3.5%. They were trading around about 3.4%. Now they have surged and spiked as high as 3.7%. So well above the Fed funds rate and a good 30 basis points higher so far. If we have a look at US 10-year yields, they were trading just above 4% before the war started. They have spiked up as well, almost up to 4.3%, so almost doing 30 basis points as well. So the bond market is certainly basically saying that they've got huge concerns that this inflation hit that is coming from these oil prices is not going to go away anytime soon. So look, that is a big warning sign for the rest of the market. If we have a look at like Fed Fund futures and what the market was pricing for Fed rate cuts this year, before the war started, they were pricing in about 60 basis points of cuts. So that was two guaranteed cuts with a possibility of a third cut. That has dropped as low as now just 20 basis points. So not even pricing in a full cut. And quite frankly, I think that that 20 basis points is probably optimistic as well. It probably should be at zero because it's very hard to see how the Fed can move with what is going on at the moment. And the risk is that if inflation really spikes up, then maybe the market might even flip that the Fed might have to hike rates. But talking about hiking rates, there's one country that will be doing that, and it looks like they'll be doing it next week. That is the RBA. So the RBA was priced in to hike maybe in April. RBA did hike at the beginning of this year. But that has been brought forward now, and the market's expecting the RBA to hike now. And the reason is because of the war and what is happening to get in front of this inflation hit that surely is going to be coming in the next month or two. So yes, look, the war is certainly having a big effect now on bond markets, and bond markets matter, and no doubt that is filtering through to most other markets. So if we have a look at equity markets, so overnight US S&P, NASDAQ, both down around about 1.5%. Now look, this has still been a pretty orderly sell-off, but obviously equity markets are getting nervous now. We've talked about this before. US equity markets have been in a 5-month range, ranging up near those record highs. It has been a raging bull market for equities for the last 3 years plus. So look, the risk is now is that potentially we are going to see a break of this 5-month range and obviously a break to the downside. So yes, the bias I would say is not buying this dip and potentially being short equities, because when we do break this range, we could see a big momentum move lower. So that is the risk. With gold was lower overnight by about 2%. It listened to bond yields. Basically, gold is a yellow metal, shiny yellow metal that yields nothing. So it does not like it when yields go up, and especially when also rate cuts get priced out. And then also on the back of what happens with these yields is you get a stronger US dollar, which is also weighs on gold. So again, a lot of the market's been conditioned to buy dips in gold and to be long gold, but at the moment it is not a one-way bet anymore. And yes, gold can obviously be could sell off, and we've seen it sell off quite violently on quite a few occasions in the past month or two. So that is also the risk. Anyway, with crude, which is the main game, at the moment we are pushing back up towards $100. Obviously not good. A couple of things that happened this week, obviously with the release of global strategic reserves in crude, that got it lower. Trump saying the war's won and it's over or close to being over, got it lower. But it seems as if none of that now matters. Market doesn't believe any of it. The strategic reserves are a band-aid. So the risk is that obviously we do go over $100 and retest that $120 high. Going into the weekend, we have gap risk. So a lot of traders obviously will not want to be short crude going into a weekend and actually position long. We saw exactly what happened last weekend when crude closed on the extreme highs at $91. You did get gap risk. Monday reopened and we flew higher. So that would be very fresh in traders' minds. So I would imagine that crude will probably do well again and go into the weekend bid. So today, especially being a Friday with the weekend coming up, I would not be fading or selling crude. I'd just be joining this rally. But obviously, if there's any positive headlines, for whatever reason, that's the only thing that is going to get this crude spike from retracing somewhat. But the bottom line is we're not going meaningfully lower, probably for some time. So buying dips at any stage is a preferred strategy. And just finally, on the currency front, look, the Aussie's been the standout mover. Obviously, we traded up to 2-3 highs this week around that 71.80 area. It's off a cent now because it is a risk currency. Risk is lower. But look, we do have that RBA meeting next week. Obviously, we've just been talking about the RBA raising rates. That is going to be a tailwind for the Aussie. In that the RBA will have and does have the highest rates out of all the major central banks, and that interest rate differential is only going to keep widening in the RBA in the Aussie's favour. So at some stage, buying dips in the Aussie, certainly it's going to work, and it's going to work exceptionally well. So if we do get Aussie much lower on risk off, I would definitely be looking to get some small longs in at a minimum on that. Anyway, we do have some PCE inflation data in the US to finish the week, so some top tier US economic data. And obviously I don't have to say that if that data does come out for whatever reason above expectations, that is the last thing this market needs, because obviously the crude spike is going to come in the inflation data next month in April. So the market certainly doesn't need inflation going up for any reason before we see that crude component come in. But if it does come out above expectations, obviously those bond yields are going to keep going higher. US dollar is going to rally with it, and risk will get hit hard. Look, it's Friday. There's going to be volatility, guaranteed. Stay safe out there. Have a great weekend, and